Morning, everyone. Welcome back. It is very nice to have you here again, joining us live, or if you're watching this after we've recorded, thank you for taking the time to join me, Austin Fitch of Horizon Investments, and I will properly introduce him in just a few minutes. And of course, we have the Tranquilli financial advisor intern for our financial position, Andrew Polson, also joining us today. As usual, I have to start our meeting with the disclosure, so I'm going to take a moment to do that. This webinar was created in November of 2021 and is provided by Horizon Investments, LLC, for educational use only, along with Tranquilli Financial Advisor. The opinions expressed herein are as of the date of this report and are subject to change without notice. Forward-looking statements cannot be guaranteed. This material should not be considered financial advice or an offer to sell any product. Horizon Investments and Tranquilli Financial Advisor reserves the right to modify our current investment strategies and techniques based on changing market dynamics or client needs. There is no guarantee that the assessments today of investments will be accurate. The discussion, outlooks, and viewpoints featured are not intended to be investment advice and do not take into account specific client investment objectives. Before investing, an investor should consider his or her investment goals and risk comfort levels and consult with his or her investment advisor and tax professional. Information has been obtained from sources believed to be reliable, but its accuracy and completeness are not guaranteed. Past performance is no guarantee of future results. Risk assist is not a guarantee against loss or declines in the value of a portfolio. It's an investment strategy that supplements a more traditional strategy by periodically investing assets in a client portfolio in fixed income securities based on Horizon Investments' view of market conditions. Furthermore, when risk assist is deployed, whether partially or entirely, to mitigate risk for an account, the account will not be fully invested in its original strategy, and accordingly, during periods of strong market growth, the account may underperform accounts that do not have risk assist feature. While risk assist was designed with the goal of limiting drawdown, Horizon is not able to predict all market conditions and ensure that risk assist will always limit drawdown as designed. Accounts with risk assist are not fully protected against all loss. This is from Horizon Investments and Tranquilli Financial Advisor, LLC. The Horizon H, Gain, Protect, Spend, Risk Assist, and Real Spend are registered trademarks of Horizon Investments. Okay, with that out of the way, and that is an important part of the conversation, I would like to properly introduce again our good friend and analyst from Horizon Investments, Austin Fitch, who is a CFA, the Chartered Financial Analyst. He is a senior analyst with Horizon Investments. I am looking at Austin's bio from Horizon Investments. He joined the firm in 2011. They have a great picture of him there. It looks like the day he got his driver's license, he joined Horizon Investments as an analyst, which we're happy about because we want someone who grew up in this business. So Austin, very good to see you again. I hope you don't mind me kidding with you to start, but we have a lot to get to today. So please properly introduce yourself to everyone again, and we'll get to it.
Absolutely. No, thanks, Lou, and appreciate you guys taking the time, or folks taking the time to join us here today. Really excited to get into what we're going to be talking about. Lou, as you mentioned, we've got a lot kind of on the plate. We're going to hit everything from inflation to China and back again. But yeah, really excited to be here. As probably most folks on this call know, Horizon and Tranquilli Financial Advisor have worked together for over a decade, going on more than 15 plus years now. So really excited to continue to be able to support you, Lou, and your business, and excited to be here. So
excellent. And as part of that support, we do have Andrew Polson, the Tranquilli Financial Advisor finance intern, who some clients will be hearing from Andrew, others will be hearing from Alina, the A team, as we put in our email today in reference to your beneficiary. So please be sure to read their email, respond to them directly, and let's get to it. And I'll just frame it out for everyone. We're going to try to keep the call to 45 minutes. We found that's a great time. We get a lot of words in during this conversation. Of course, you're always welcome to reach out to me. We can even schedule times with Austin if you'd like to get a more we'll say direct or private conversation if you'd like to do so. So we're going to cover inflation. We're going to start there, but we are going to talk about China is going to be a part of this discussion, something that we talked about in the past. what we're discussing as part of client portfolios there. And then we're going to wrap it up with a 2022 outlook. So Austin, let's jump right into inflation. I'm just going to let you go and I'll interject as necessary, but let's talk about inflation. It is the conversation of the day, if I could put it that way.
It's the conversation of the day, the week, the month, probably the year at this point.
There you go. That's right.
No, and I think it's absolutely a fair conversation, right? And the reason I say that is because on the face of it, we have absolutely started to see price increases in our daily lives, right? I think we were looking at something just the other day that food and beverage, the food and beverage component of CPI, which CPI is kind of the broad measure of inflation, and that piece of the inflation index, if you will, has been up on average 3 to 4% on a trailing 12-month basis for over a year now. So that hits folks in the pocketbook when they go out to dinner, when they go to the grocery store. You see that on a daily basis, which is again why you're getting kind of smacked in the face with it. Everybody's seen the headlines around whether it's lumber prices or transportation costs or how much it costs to rent a car or airline tickets. All of those things have absolutely popped up within the last 6, 9, 12 months, depending on kind of where they've fallen in the cycle. So inflation from a conversation standpoint is absolutely a legitimate conversation. For those of you maybe that have paid closer attention to maybe some of the headlines that have come across, you've probably heard this term transitory. And the reason that's important is because kind of the Federal Reserve, so the central bank here in the U.S. is looking at the inflation that we're seeing today, and they're still till today, and I would say that there's not an expectation for that to change imminently, but they're still calling that inflation component transitory, which means it's more shorter term in nature. They don't expect longer term inflation to be persistent over the next 5, 10, 15 years. So they're not necessarily expecting at this point this idea of going back to the 1970s where you see, pretty serious inflation for a pretty prolonged period of time. Their definition of that transitory piece, however, is something that's a little bit nebulous, right? When that term was initially introduced last year as part of the normal lexicon, what you found was a lot of folks thought that meant it would be gone. Inflation would be gone in 3 to 6 months, right? It would be done before 2020 was over. Maybe it would go away with COVID. Well, as we've learned, COVID itself hasn't gone away either. But what we've learned is that their view of transitory inflation is actually a little bit longer, right? And you started to see that in terms of how the market's pricing it in, is this idea of a short-term inflation, bout of inflation may still last for, a year or two. And that's really what we're in the middle of right now, is that period of kind of that what they're calling transitory. Again, we're watching to make sure that it doesn't turn into long-term persistent inflation. But what you're seeing from a Fed standpoint, what the market's actually pricing in, is this idea that a kind of transitory or shorter term inflation still plays out over, a year or two. So we still have some time to kind of work through that inflationary period.
And with that, is it transitory, or is it a permanent inflation for, call it, a small segment of the economy? And the follow up to that is, how does it impact the market? You're saying you just said the market is pricing it in. Well, wouldn't it seem like it would be a headwind or a negative for the market to have even transitory inflation?
Yeah, no, for sure. So what I would tell you, Lou, from a whether or not there are bits and pieces of it that are persistent, I think that's absolutely fair, that there may be parts of the economy that do have price increases that don't necessarily go back. What we've always seen, and everybody probably knows this, is prices are sticky, especially on the upside, right? If gas goes from $3 to $3.50, it can go up much quicker than it's going to go back down to $3. So I think that kind of gets at what you're talking about. I would tell you what we've started to see, and we'll talk a little bit more about this, I'm sure here in a second, is you started to see really, and really what the Fed's looking at from a transitory perspective, and why they're using that word is because really what you're seeing in terms of these price increases is coming from bottlenecks, right? And we saw it, I mentioned lumber earlier, you actually saw it in lumber markets earlier this year, where lumber prices over the course of about 2 months increased 4 times. Now today they're back to where they were at the beginning, but that's the definition of a bottleneck, where you have supply starting to skyrocket coming out of COVID. You've got demand starting to skyrocket coming out of COVID. You've got supply still kind of, I would say, offline in terms of the manufacturing of the lumber and of the raw materials there. And then you also have kind of inventories that have been drawn down. So that is the perfect, storm, if you will, for a bottleneck. And you've seen that in a lot of different areas of the economy. Lumber is the example from earlier this year. Shipping and transportation is the example that we're living through right now. So that's why they're using kind of this word transitory, is really what it boils down to, is you're starting to see these bottlenecks pop up in different segments of the economy. And Lou, to your point is, at what point do they start to unwind, and do you see those prices decrease? Yes, you probably will. It just may take a little bit longer on the backside.
Lawson, I'm just going to interject in there. I'll be awfully interested to note at another or a future conversation that we have, whether the prices actually decline, because just in listening to you talk about it, the transitory part of it, go back a decade ago and I was in Cape May, New Jersey. And for those of you watching from a distance, if you're not unfamiliar with where Cape May is, when you look at New Jersey, it's the peninsula at the very bottom. Cheeseburger, this is a decade or so ago, at $10. I was really mad about that. And then they wanted to charge me $1.50 for the lettuce and tomato on additional on the cheeseburger. That same cheeseburger is $15 now. So I will wait for the day that the prices actually do start to drop again. I haven't experienced that.
No, and I think there's always, and again, everybody probably knows this to some extent, there's always some level of inflation that is normal, right? And I would tell you what the Fed kind of expects in terms of normal inflation is about 2% every year. And I guess that's when I say kind of prices start to recede or go back. They go back to kind of what would have been normal given a 2% kind of normal inflationary period. Right now, what you're seeing, especially like in the food and beverage space, is 3, 4, 5%. So the question is, does that come back in? I think that's absolutely a fair question, and something that we're watching for on our side. Your question about kind of market impact and what that means, I think, yes, you're absolutely right. It's a potential headwind, especially as you get out into 2022, which we'll talk a little bit more about towards the end of the call. But what I would tell you is the real impact is the potential for, inflation kind of going maybe a little bit faster than was otherwise expected. The risk is that you start to get interest rate hikes from the Fed in an attempt to slow the inflation down. And if that's the case, raising interest rates will obviously have an impact on the economy in terms of slowing down growth, creating some headwinds and challenges there. So it's not necessarily the inflation directly that we would expect. Again, we're not in the camp that would expect hyperinflation. We're not expecting 10, 15%. But to the extent that you see inflation start to cause the Fed to have to act from an interest rate perspective, that's the real risk in terms of headwinds as you get into 2022.
Understood. And we touched on it, waves of bottlenecks, wage inflation, and the labor market. And your focus at Horizon Investments is on the productivity gains and how that could potentially counteract bottlenecking, wage inflation, labor market. Yeah. So if we could touch on that for a few minutes.
No, for sure. I mean, and the idea of waves of bottlenecks is something that we've been kind of batting around for a little while now. And it's this idea that when we turn the economy off to some extent 18 months ago, it really was a circuit breaker, a light switch, right? We went from 100% productivity and from an economy perspective down to 25 to 30. As we're coming back on, what we're learning is it's not just a light switch in the other direction. You can't just flip the breaker and everything's back on. What we're seeing is it's a little bit more of that dimmer switch, but it comes in fits and starts. And that's those bottlenecks that we're talking about. Again, we've used the example of lumber and shipping and you name it, what we've seen over the last 9 months. But the idea being that, lumber was the bottleneck earlier this year. Shipping was, is the bottleneck now. There's, semiconductors was a bottleneck this summer. It's a question of there's likely to be a bottleneck as we get into the first quarter of 2022. And what that really boils down to is, and you talked about wages and kind of the labor markets, especially given where we sit from a labor perspective, you're just seeing things start to fully come back online, or attempting to come back online, and we're not fully there yet, whether that's because there's not enough workers, or there's not enough raw material or whatever it may be. So that's the challenge. Now, you mentioned this idea of productivity and efficiency. I think the comment that our CIO made a couple of weeks ago was, if you're talking about inflation and you're not talking about productivity, then you just need to stop talking. Because the idea being that productivity is a dampener of inflation just by definition. And maybe a good example is we've actually seen it here in Charlotte. A local fast food chain actually purchased an AI, artificial intelligence, think of it as Alexa, to serve as their drive-through order system. So they obviously during COVID, they scaled back in terms of employees. As they were looking to rehire, they were using this artificial intelligence system to take orders as you pulled through the drive-through. Right? You pulled up to the drive-through, and instead of a human being asking you what you want your order to be, it was think of it as Alexa asking you what you want your order to be. That eliminates that position. When you get to the window, you just put your card in the card reader. Now, granted, somebody still has to be there to put your meal in a bag and hand you the bag, but they fully eliminated that position that has been around for 50, 60, 70 years, however long fast food's been a thing. And that's something that if we think about efficiency, the way that efficiency works and productivity works is we don't go backwards, right? That job made it, especially there, but if you think about more broadly, that job's never coming back. Which if you think about wage inflation, which we started to talk about, that's the real risk as we get into, does inflation take hold and persist for a long period of time? Well, if you're able to eliminate certain jobs that right now you have to pay more to get them off the sidelines, then potentially you're helping, that's helping dampen down kind of the potential for that wage inflation conversation. It's really interesting if you look at the total GDP of the U.S. relative to the labor market. It only took us about 9 months to get back to producing the same level of GDP that we did as we went through kind of that COVID dip. So think of it as we hit the bottom in March. Really by the end of last year, from a GDP perspective, we were at the same level as we were pre-COVID.
Okay. And I just wanted to interject for a moment because GDP, I'm sure everyone on the call knows, but I just want to take a moment, a pause, and talk about it. So we had a significant reduction in the gross domestic product, what was produced in the United States during COVID. So that period of time where, as you said, the switch was turned off. Have we made up for that? Can we make up for that? If we've reached the level pre-COVID of production, what about what was lost during COVID? Is there some, again, headwind challenge to the market, supply chain? We've heard a lot of supply chain conversation, which we did touch on with the waves of bottlenecking. Isn't all of that a challenge moving forward, or is it the fact that there's a catch-up period that we need to go through, and there's no pun intended as that relates to fast food and this conversation, the catch-up? But is there a time frame to put that GDP back into the economy that was lost during that COVID period?
No, for sure. That's a good question. What I would tell you is, yes, some of that continues to come back, but what we found, and honestly, this is what you see with any economy that goes through any recession, is the economy that comes out of the recession doesn't necessarily look like the economy that went into the recession, meaning that the GDP, what the country as a whole or the economy as a whole produces, it may be coming from different segments of the economy, right? So a good example is, if you guys are anything like us, we order a lot more from Amazon today than we did from Amazon 2 years ago, in terms of boxes showing up at the door. So if you think about what that means just in terms of, supply, Lou, you talked about supply chain. What does that mean in terms of, delivery services? What does that mean in terms of cardboard box manufacturers? Like, there are so many things that portion of the economy is much stronger than it was pre-COVID. And there's definitely areas of the economy that are worse off than they were pre-COVID. So you've seen this kind of shifting of the economy. Now, to your question, does it come back, and do we start to see areas that were hardest hit come back? Yeah, I think you still see that, but it may never get back to the level that it was when it comes to retail, in terms of folks going to the mall, or when it comes to folks going out to eat, or when it comes to travel and leisure. Like, all of those things may look a little different. Business travel, great example. Business travel is down dramatically over the last 12 months, even as the economy has started to open back up, because more folks are doing meetings over Zoom. They realize, hey, I don't need to fly in for that one-day meeting. I can be a lot more efficient and do a meeting on Zoom. If that's the case, again, the economy shifting as a whole. What you're seeing, and kind of what we're talking about, is you're actually getting more productivity out of the economy. It's just coming from different places.
Understood. Okay. And we've given inflation just about 20 minutes here on the call. And as I stated from the beginning, it's a topic that is front and center. So I wanted to give it plenty of time. If you would just touch on the policy, the current policies in the U.S., thoughts you have about what the help or hindrance that those policies may be on the markets, which is, of course, that's why we're here. We're talking about investing money in markets again. We'll put both the bond market and the stock market when I use the word markets.
Yep. No, and I think it's a good point to mention. Yes, we are entirely focused on the impact on the markets. Not necessarily the social impact or any other debates that want or need politics, on the politics side. But I think what we would say is, in terms of looking forward, the policy piece could have a pretty big impact in the U.S., not surprisingly. Probably the biggest one that's being talked about is the tax side of things. Now, I say that with a little bit of a caveat, because if you read the headlines, or you read, depending on which news channel you're watching, either you'll think that the new tax plan is a great idea, or you'll think it's the worst thing in the world. What I would tell you from a market perspective is it's somewhere in the middle. And that's generally kind of how things fall out from a market perspective when it comes to politics being somewhat polarized. I say that because in reality, yes, tax hikes will serve as a marginal headwind, right? All things considered, higher taxes tend to create a little bit more of a headwind from a corporate perspective. Now, I say that, and then the caveat being, it's not that big of an impact. You're looking at, on the margin, maybe 2-3% in terms of kind of bottom line effect. It's not 10%, it's not 15%. Again, you could believe that. You could also believe that it's the greatest thing in the world. What we're seeing in terms of actually running the numbers is, with the tax proposals that are currently in the works. Yes, it's a marginal headwind. No, it's probably not going to be the worst thing in the world. In reality, what you're looking at is probably, from a level of headwind perspective, back to where we were during the Obama administration. Where you actually saw, you saw certain years where business growth was actually fairly strong, in spite of where the taxes set at that, tax rates set at that point. So that's important to understand from the policy perspective. The other piece, and we kicked the can a little bit in October with the debt ceiling conversation. That's something that will be revisited as we get towards the end of the year, almost certainly. I think the conversation there is, yes, again, on the margin, taking on more debt in the long term can absolutely create challenges. What I would tell you, and Lou, I know we've had this conversation, is unfortunately, fortunately, I don't know how you look at it. Even if the U.S. takes on more debt, we're still nowhere near as bad off as many other major economies of the world. In terms of debt to GDP, Japan is 2.5 times. Europe is almost 2 times. Even if we took on additional debt here in the U.S., we'd be pushing about 1.25. So the joke that we've talked about is we may be the smartest kid in summer school when it comes to our balance sheet, if you will, within the U.S. Again, I absolutely think that this is going to be a problem that honestly probably my kids, or for that matter, grandkids down the road, somebody's going to have to deal with it, and there's going to be a reckoning at some point. But in terms of immediate impact, you're really probably not looking at the debt ceiling kind of debt conversation just in general having an impact anytime in the foreseeable future.
All right, and I just want to make this statement, and we'll move on to the next topic about the debt ceiling argument. Okay, that's even if you can't see my hands, air quotes. Okay, I'll even dare to do that. The debt ceiling argument is one of the most ridiculous annual, if you will, political fights, because what that means, the debt ceiling means, is the U.S. stops paying its bills. So if the U.S. were to discontinue paying its bills, you would just open up the entire planet that we are working with. We'll call the even friendly countries and even not quite as friendly countries that we work with from a monetary standpoint. All of these things that we're talking about, you would end those relationships immediately. The debt ceiling is always going up. Okay, it's just a silly headline that is I'll say thrown around so that I think it's a red herring at this point of politics. So we're always going to raise the debt ceiling. We just simply have to. Okay, otherwise you would hand off onto our next topic, the support of monetary support to a country like China, and I don't know that anyone is ready to do that or even accept that type of support. So let's touch on this subject of what when we prepared for the call, Horizon believes could be a more serious challenge to markets, global economies than is being discussed at this moment.
No, I think that's absolutely right, Lou. I think the way that we would look at it is, we talked about inflation, we've talked a little bit about policy, but in our view, the biggest risk to really the global economy and obviously the markets that come along with that is China as we get into 2022. And the reason I say that is, and they've said it for a couple years now in terms of telling us what they're going to do. So you actually have been reading, what they've put out in terms of the Communist Party. If you listen to or read what President Xi from China has said, yes, they're absolutely scaling back from a growth perspective. And what does that mean? Well, if you look back really over the last 20 or so years, China has been one of the main drivers of global growth. But that's also been at a time where they've used capitalism. They call it a transitional economic form, is what they term their version of capitalism over the last 20 or so years, as a way to really build wealth in their country, so that then they can, at some point, and now we're starting to see that, scale back on capitalistic policies and really kind of go, to some extent, full bore on kind of the socialism, communism, I say experiment. We've obviously seen how other versions of those experiments have turned out. I think we all here probably on this call, and definitely those of us that are speaking, probably have an opinion that maybe it's probably not going to turn out in the best scenario. But they seem to believe over there in terms of the Communist Party that they have figured something out in terms of kind of this greater good. And what that means, again, is they start to scale back from a capitalist perspective. And you've started to see it really just over the last 9 or so months. Like if you look back at the beginning of the year, you started to see regulations be put in place that made it more difficult to start new businesses, that made it more difficult to make and accumulate wealth. All of those things, again, are consistent with capitalism, not necessarily consistent with socialism. And to the extent that they had been accepted or I would say they were overlooked over the last 2 decades, they're starting to crack down on that. Now, again, we use the light switch analogy here. You can say that they're not going to flip it off. Like capitalism is not going away tomorrow in China. But to the extent that they start to scale back more and more, there has to be somebody there to pick up the slack. And I think what we've talked about internally is to the extent that that is a measured scale back from China's perspective, yes, you probably have somewhere else in the world, some other economy able to pick up the slack, and you don't really notice global growth coming under as much pressure, whether that's another emerging economy, India, Malaysia, Indonesia. Like there's so many countries out there that in theory could pick up the slack. Or maybe it's a bigger economy. Maybe the U.S. picks up more from a manufacturing perspective. Maybe China, Mexico. There are other areas of the world that can pick it up potentially. But to the extent that China does kind of this scale back in a measured pace, it's probably a little bit less risky. To the extent that they do start to accelerate that process and they become more insulated there within their borders. That puts more pressure on the rest of the world. And that's what we're looking at as we get into 2022. What's the pace of how quickly they start to remove kind of capitalistic practices in their economy? And what does that mean, obviously, for global growth? Again, they've grown at 6, 7, 8% for 2 decades now. Given the size of their economy, in terms of where it stands in the global economy spectrum, if you had that growth engine helping drive growth and all of a sudden it starts to scale back and if it does it quicker as opposed to at a more measured pace, then we definitely think there could be some risk there in terms of putting pressure on the rest of the world.
All right. And just to put a disclosure on this part of the conversation, which I can't state enough is such an important conversation as it applies to investing. We are discussing the Chinese Communist Party, who is in charge of China, and they put themselves in charge of China, we'll say permanently, at least as of today. And that's no opinion or anything else. That's based on what has occurred over Xi's presidency to begin with, but now I think you would even dare call it a reign at this point. They have made it clear, the Chinese Communist Party, that they are cracking down, and I read that, and I read all the usual suspects, if you will, of papers that you would think that I would, without giving free advertising to the New York Times or the Wall Street Journal. So I'm reading both, all right, and the term crackdown I don't think is given enough, if you will, definition as of what it means. Alibaba being a great example of a Chinese firm that is being cracked down on. It's not a crackdown as it applies to Alibaba growing. It's actually just the opposite, putting restrictions on how they can grow. I don't think it's defined correctly by any of the resources that we would expect to properly define what it means by cracking down. And for our purposes, directly, a company like a McDonald's or a Starbucks that are US-based companies that have expanded into China, Apple, Google, adjusting the Google searches within China based on the Chinese Communist Party's demands, so that they could even do business there. The government of China reserved the right to say no, to shut the businesses down, to invite them to leave their country. Not something that we're used to here in a capitalist economy.
And that's a great point, Lou, and something that we have to, I would say we've struggled with internally is you sit back and you look at it and it's very easy to say, well, why in the world would they do this? And it's because, again, we come at it from a very different perspective. We've grown up in a very different society. If you talk to folks over there, what they experience and what they have experienced is very different, and their starting point is just a different understanding. So that's, again, trying to wrap your head around that can sometimes drive you crazy for sure.
Well, and we have to do so because we're talking with investors and we're talking about investing, and China has been a place based on all that growth that you talked about that has been looked to for growth. I think right now we're taking a bit of a pause there as it applies to looking to China for our clients. That could change, but a lot would have to change for that to change. So I think that's a good jumping off spot with just a little while to go here, just a few minutes. I'd like to touch on, if we can, for a moment. We say a moment, we'll give it a couple of minutes. We've talked about cryptocurrency in the past so frequently that I had clients reach out and folks that have listened after the fact and say, are you considering cryptocurrency? We've had so many conversations about it. We've tabled it for a while. I think it's worthwhile to bring it back up because I love baseball, in case anyone on the call didn't know that. I'm a huge baseball fan. There's an official crypto of Major League Baseball. I'm reading of exchange traded funds that are being opened, trading on the value of crypto. I'm not changing my opinion, okay? Like, someone's going to have to support this thing that isn't someone on the internet before I jump in. And I did read yesterday about Coinbase, and that, so I'm saying supposedly because I still haven't dug in fully, but that there will be some kind of support, but it's not through a solvent government that support will be. It's people, a group, business, whatever it may be. What is the current stance of Horizon on crypto, digital, Ethereum? I'm trying to get all the different names out, but you know what I'm talking about. Online currency that isn't supported, that isn't a fiat money.
Yeah.
What's
I think I would maybe break that statement into two parts in terms of Horizon's view. I think we are of the belief that digital currency will absolutely be a way of the future.
And I agree.
A digital currency not supported by a central bank will not be the way of the future.
And I would agree. Okay.
And the reason we would say that is because at the end of the day, do any of us really believe that the Treasury here in the U.S. or any other central bank or Treasury around the world is going to give up the ability to control the money supply? And I would just tell you, within the U.S., like, there's no chance in the world that would happen. And what a lot of people also don't realize is, despite what you've probably heard or read about just how big the crypto market is from a dollar's perspective, if the U.S. and the Treasury or the central bank collectively, if they decided they wanted to make Bitcoin go away, or Ethereum, or pick your cryptocurrency, if they decided they wanted to do that and basically go out and buy all of it today or tomorrow or next week, like, it could be gone overnight, right? And now, Lou, we've talked about this. That could have some impact, to say the least. There could be an evaporation of wealth for a lot of people that have maybe ridden the bull, if you will, over the last 18 months, 2 years, where you've seen that kind of skyrocket in certain areas. So I don't think it's in their best interest to do that necessarily, make it go away. But I also think, and I would tell folks this, is the U.S. and really every other central bank and treasury out there is absolutely exploring ways. There are a number of digital currencies that are actually in pilot programs or beta tests around the world. So that technology is already being developed and rolled out in some places. It's just a matter of time before that happens in the U.S. And to the extent that there is a digital dollar one day, sooner rather than later, you have to believe. Then the question is, well, what's the point of cryptocurrency that doesn't have the backing of a central government other than the dark web or a black market somewhere? Yes, that may still be used, but in reality, there was always some form of currency that was used there. Maybe historically that was, drugs or illicit goods or whatever it may be. Now it's just a cryptocurrency that is kind of serving that role. We think that probably exists, but not nearly the scope of what it exists today as you actually start to get a digital government-backed currency here in the future.
And it's not an exchange traded fund that you can go buy. So it's if I sound skeptical, almost annoyed by it, it's because I fear for those people that aren't working with someone that is, from this standpoint, I'll say more cautious, conservative, thoughtful about where their money is going. It is just someone on the internet is valuing this thing, and that's just no place to go invest your money. I don't believe that at all. And the speculative part of it, sure, I get it. It would have been great to go make money on it, but the level of risk, if 0 is no risk and 100 is the most risk you could possibly think of, this is 10,000 on that scale, in my opinion. So that's thank you for wrapping that up.
I think that's a good point. The only other thing I would add, and Lou, you kind of mentioned it, like right now, it's not truly an investable security in terms of you can't put it in an account that you would have other stocks or ETFs or bonds or mutual funds in. And the other point of that too is it's not a tool that you use for financial planning, like any way, shape, or form, right? Yeah. If you want to go to Vegas, go to Vegas. It's the same thing with crypto.
Sure. All right. And let's, we promised to wrap it up with an outlook for 2022. I mean, incredibly, we're on 2 years of, really 2 full years of COVID living, if you will. Hopefully with some breaks coming up here. There have been some breaks. I've had the ability to go out and travel a little bit to see some investment firms, to see some people throughout the country, go to a concert or two. The outlook for 2022, give us Horizon's current viewpoint as we wrap up 2021 and market outlooks, and again, broad markets, stocks, bonds, please.
No, I would tell you broadly on the stock side of things, we're pretty positive right now, probably at least for the next 3 to 6 months. And I say that because we didn't talk a lot about this, but the consumer within the US and really just globally is actually in a really good spot. So despite some of the headwinds that we talked about, we think those are pushed out a little bit further into mid 2022 before you potentially get the convergence of China. If inflation's still around, maybe then it starts to really become an issue when it comes to interest rate hikes. Tax policy really starts to probably take hold later next year. That confluence of events isn't a first quarter, maybe even not a second quarter. It's probably a second half of 22 issue. We think between now and then, the strength of the consumer in terms of their personal kind of financial health, the personal balance sheet, if you will, it's actually in a really good spot. Folks actually saved a lot of money over the last 18 months, whether that's because there was additional unemployment, whether that was because they weren't traveling as much. There's lots of reasons why. But personal balance sheets, folks' kind of debt to income ratios are at all-time lows. You have the consumer ready to kind of take that baton and run with it to some extent. And again, we see that as a positive. I would say on the bond side of things, we continue to think that that's going to be a tough spot. Interest rates obviously remain next to nothing. And really the only place that you could go is if you do get inflation, you get interest rates going up, and that creates headwinds for bond prices. So you potentially see losses in bond markets really for the first time in quite some time. So we think stocks continue to be kind of the place to be to the extent that you're willing to accept the risk that comes with that, to the extent that you need to balance that with some form of risk mitigation or a segment of the portfolio that does have kind of some fixed income or bond exposure. Absolutely. But I think the caveat being don't expect a lot out of the bond segment of the portfolio.
We're going to continue to take that approach as it applies to bonds until we get some kind of break, change, whatever it may be. Interest rate wise, they're there for the, if you will, the we can't say more secure, but we can say less stock-like volatility that they could provide outside high yields, of course. So I think with that outlook, anything else to add, Austin, that we didn't touch on that you could share with everyone?
I mean, I think we hit a lot. I mentioned the consumer there at the end. The only thing I would say is we do think that's important in terms of taking that baton, because we do think the government's eventually, right? It's probably going to happen, maybe even this month, that they'll announce that the government's going to start to pull back a little bit. Which, again, as long as the consumer, which we believe is kind of ready, willing, and able to start spending more money, and you started to see it kind of pop up this summer, to the extent that that takes off, we think that transition really can bode well for the economy for the next little bit. So
excellent. Well, Austin, as always, thank you so much. We're at 41 minutes of conversation. I think that'll do it. I want to thank Andrew for sitting in with us as well, taking some notes. Everyone that's on the call live, thank you so much for taking the time out of your day. And as a reminder, we do have another call this Friday, November 5th at 11 a.m. with Chris Cook of Beacon Capital Management. So we're going to pick up the conversation, add some different elements to it with Chris. Austin, always a job well done. We'll certainly do it again, if not before the end of 2021. We'll look forward to doing it early in the first quarter of 2022. And thank you all again for being a part of the conversation. This webinar was created in November of 2021 and is provided by Horizon Investments, LLC, for educational use only, along with Tranquilli Financial Advisor. The opinions expressed herein are as of the date of this report and are subject to change without notice. Forward-looking statements cannot be guaranteed. This material should not be considered financial advice or an offer to sell any product. Horizon Investments and Tranquilli Financial Advisor reserves the right to modify our current investment strategies and techniques based on changing market dynamics or client needs. There is no guarantee that the assessments today of investments will be accurate. The discussion, outlooks, and viewpoints featured are not intended to be investment advice and do not take into account specific client investment objectives. Before investing, an investor should consider his or her investment goals and risk comfort levels and consult with his or her investment advisor and tax professional. Information has been obtained from sources believed to be reliable, but its accuracy and completeness are not guaranteed. Past performance is no guarantee of future results. Risk assist is not a guarantee against loss or declines in the value of a portfolio. It's an investment strategy that supplements a more traditional strategy by periodically investing assets in a client portfolio in fixed income securities based on Horizon Investments' view of market conditions. Furthermore, when risk assist is deployed, whether partially or entirely, to mitigate risk for an account, the account will not be fully invested in its original strategy, and accordingly, during periods of strong market growth, the account may underperform accounts that do not have risk assist feature. While risk assist was designed with the goal of limiting drawdown, Horizon is not able to predict all market conditions and ensure that risk assist will always limit drawdown as designed. Accounts with risk assist are not fully protected against all loss. This is from Horizon Investments and Tranquilli Financial Advisor, LLC. The Horizon H, Gain, Protect, Spend, Risk Assist, and Real Spend are registered trademarks of Horizon Investments.